In the years following the 2008 global financial crisis, China's robust growth helped support the world economy, offering a lifeline when many nations were struggling. For over a decade, China's booming infrastructure projects, property market expansions, and rising consumer spending were seen as pillars of its remarkable economic story. Here's the GDP growth of China compared to the entire world, data that was published by the World Bank. As you can see, China has been growing so much faster than the entire world. But without China, the world would actually be so much slower. Several reports indicate that over the past 10 years, from 2014 to 2024, China had contributed a 30.9% to the overall growth of the entire world. That is followed by India. But the growth contribution is nearly half of what China had contributed at only 16.1%, and even the United States at just 9%. This growth, however, has been recently seeing significant challenges. And that's due to an economic indicator called inflation. Recently, we have seen inflation skyrocket in many economies globally, ranging from the most advanced economy to developing ones. Here's a graph on the inflation rate, consumer prices of East Asia and Pacific, as well as North America. You can see just how fast inflation grew from 2020 to 2022. That problem led central bankers and monetary authorities to hike up interest rates to ease inflation. But China does not have that very same story. China faces the exact opposite of inflation, which is deflation. Here's a graph comparing China to these economic groups. As you can see, China's inflation rate didn't go up since 2020. It has gone down, with the latest year available for 2023 showing an inflation rate of only 0.2%. That is nowhere near this comparative group. Furthermore, let's even take this further and actually take a look at China's inflation rate by month. Here you can see that China's inflation rate has actually been negative, or at a deflation in some months in 2023 and 2024. Even with the latest data available for November of 2024 showing an inflation rate of only 0.2%. That isn't really good. Why? Well, that's because deflation, simply put, is the persistent decrease in the general price level of goods and services. Although this might sound like good news for consumers, as it brings lower prices, after all. Even some news reports recently have emerged that quote President Xi Jinping asking, "What's so bad about deflation?" It comes from the fact that President Xi thinks that people would love it when things get cheaper. That is correct. Who doesn't want goods and services to become cheaper? Well, there's just one problem with deflation. When goods and services go down consistently in price, consumers and businesses may begin to expect prices to fall even further. This expectation can lead to delayed spending and investment, as people hold off on purchases or investments in hopes of getting better deals in the future. While this behavior may seem rational on an individual level, it can have a devastating impact on the economy as a whole. One of the greatest examples we can even use today is no other than China's neighbor, Japan. Japan was once an economic powerhouse that nearly saw its economic output, or GDP, rival that of the United States. But over the past few decades, Japan has been plunged into a deflation. Here's a graph on Japan's inflation rate, data from the World Bank. As you can see, from 2000 to 2020, inflation rate was either negative or deflation, or just merely a couple of points, but not as much as 1%. It was only in a number of years when it actually reached 1 or more. This deflation was then a headache for Japan's policymakers, who struggled to stimulate the economy despite implementing a variety of measures. The government was, indeed, desperate to fix this. They introduced ultra-low interest rates, massive fiscal stimulus, and aggressive quantitative easing by the Bank of Japan. And that's all to fix their deflation. Deflation had wreaked havoc in the Japanese economy as it forced businesses to invest less, which then led to wages stagnating and consumer spending remained subdued. Even with a strong industrial base and technological prowess, Japan's economy was stuck in a low-growth trap, one that it is still working to escape. But probably the biggest problem that deflation has brought to Japan and may bring to China is debt. Japan, over the past decades, has become one of the biggest holders of national debts in the entire world. Here's a graph on Japan's gross general government debt, data from the International Monetary Fund. This story has continuously been spread across the entire world. China, on the other hand, has also seen its debt to rise tremendously. Here, the graph with China added onto it shows just how fast their gross general government debt has risen. But what's the relation between deflation and debt, you ask? Well, the relationship lies in the real value of debt and how deflation affects it. When deflation occurs, the general price level of goods and services falls, but the nominal value of debt remains unchanged. This means the real burden of debt, what it actually costs to repay it in terms of purchasing power, rises. Let's give an example to make it clearer. Consider a company that has borrowed 1 million yuan at an interest rate of 5% to finance its operations. Under normal inflationary conditions, the company might expect to repay this loan with revenue generated from the higher prices of goods and services it sells over time. However, if deflation occurs and prices drop, the company's revenue may decline, making it harder to cover both the loan principal and interest payments. The real cost of the debt has effectively increased because the value of the money needed to repay the loan has risen in purchasing power. Now imagine this scenario magnified across an entire economy. Businesses, local governments, and even households face the same issue. Their debt obligations become heavier in real terms. This can lead to a cascade of defaults as struggling borrowers fail to meet their repayment schedules. In turn, banks and financial institutions burdened with bad debts may tighten credit conditions, further constraining economic activity and deepening the deflationary spiral. For China, the risks are even more pronounced given the structure of its economy. The country's rapid development has been heavily reliant on debt-fueled investments, particularly in real estate and infrastructure. Local governments have borrowed extensively to fund ambitious projects, and the property sector has served as a key driver of growth. However, with property prices declining and land sales slowing, the revenue streams that once supported these debts are drying up. Now, it's not just the consumer price index that matters here. China's deflation also extends to the producer price index. Here's a graph on China for that matter. As you can see, unlike the consumer price index, the producer price index has actually been going down over the past few years. But what exactly is the producer price index? Well, the producer price index, PPI, measures the average change over time in the selling prices received by domestic producers for their goods and services. In simpler terms, the PPI shows how much money businesses are making from the goods they produce. When the PPI goes down, it means producers are earning less because they are selling their products at lower prices. This can happen when there's too much supply, weak demand, or both. So, what's driving China's deflation then? Well, it lies in three things. The first is weak domestic demand. Ever since the COVID-19 pandemic and China ending its most stringent pandemic-related restrictions by late 2022, consumer confidence has not fully rebounded. Households and businesses that felt economic strain during repeated lockdowns remain cautious, saving rather than spending. Here's a graph on China's consumer confidence. As you can see, since early 2022, consumer confidence has continued to stay low, and a strong reason behind this is because of the property sector slowdown that we saw in the past few years. In case you're not aware of it, China saw a property crisis. The property market has been one of the main pillars of China's growth. However, high-profile property developers, like Evergrande, have faced liquidity challenges. Here's a graph on China's real residential property prices. As you can see, house prices have continued to plummet, which was last seen since 2015. When house prices fall, it creates a ripple effect throughout the economy. Property developers struggle to meet their financial obligations, leading to halted construction projects and layoffs. Homeowners feel less wealthy, reducing their spending on other goods and services. Local governments, heavily reliant on land sales for revenue, also face financial strain, limiting their ability to invest in infrastructure or public services. This combination of factors contributes to weak domestic demand, reinforcing deflationary pressures. So, is China doing anything to fix this? Well, of course they are. They have introduced several stimulus measures. For instance, in September of 2024, they rolled out a broad stimulus plan that included a massive 1.4 trillion program to help local governments deal with their debt. Then, the monetary authorities have also continued to push interest rates down, making loans cheaper. President Xi Jinping, during the Central Economic Work Conference, even pledged to increase the fiscal deficit target. What that basically means is that the government would spend more than it earns, borrowing funds to stimulate the economy. However, China's policymakers have been steering away from their traditional strategy of boosting growth. Previously, they have relied heavily on infrastructure projects and property market expansions to help push the economy up. But as we saw in recent years, it hasn't really been proven to do well in the long run. Hence, President Xi Jinping is focused on transitioning the economy toward new drivers of growth, such as advanced technologies and innovation. As a result, recent stimulus measures have been moderate, leaving investors uncertain about the economic outlook. The reflection is seen in China's 10-year government bond yield, which, as you can see in the graph right here, has dropped substantially. The reason why this is so important, and why we use this metric, is because the 10-year government bond yield serves as a key indicator of investor confidence in the economy. When yields drop, it often signals that investors are seeking safer assets due to concerns about economic growth. A low yield also reflects expectations of prolonged economic weakness, as it suggests that the market anticipates low inflation or even deflation in the future. But anyway, do let us know what you think. Thanks for watching.